The bond market collapse, when governments lose control of debt. 1. The setup. Something's breaking in the global bond markets. Long-term yields have surged to levels not seen in decades. The U.S. long bond is back to where it stood in 2007. The Japanese 40-year hit a record 3.19%, and the U.K.'s long bond is flirting with panic-era highs from the 1998 long-term capital management collapse. That's not normal. That's The world's governments are all trying to borrow at the same time while pretending inflation will behave. Spoiler alert, it won't. The higher yields climb, the more pain piles onto leveraged investors, risk-hungry traders, and debt-drunk governments. So what does that actually mean? It means the debt party is running out of music. Footnote. Global bond yields rising simultaneously indicates a systemic loss of investor confidence in sovereign debt stability. 2. The hidden problem. Politicians love to spend, but math doesn't share their enthusiasm. The U.S. deficit to GDP ratio just hit 6.7%, the highest ever seen outside war or recession. They call it stimulus. Economists call it trouble. A new spending bill adds another few trillion in promises no one plans to pay for. If a recession hits, debt explodes even faster, possibly into the teens or low 20s as a percent of GDP. It's like watching someone fill a swimming pool with a teaspoon and brag about staying dry. So what does that actually mean? It means fiscal conservatism is now a historical term, like rotary phone. Footnote. Excessive deficit spending during economic expansion signals a structural fiscal imbalance, not temporary stimulus. 3. The interest rate trap. Governments claim they can outgrow debt through pro-growth policy. In reality, it's like sprinting uphill while your shoes are on fire. The Treasury dreams of growing faster than compounding debt. But unless global GDP hits double digits for 50 straight years, that's not happening. When they try, they usually unleash inflation instead. Higher GDP, sure, but higher prices too. And then the central banks, trapped between inflation and recession, have to pick which disaster to manage first. Spoiler, they usually choose inflation. Footnote. Attempts to grow faster than debt through monetary expansion usually trigger inflation, not sustainable productivity growth. 4. The global domino. Yields are rising everywhere. The U.S. 10-year hit 4.6%. The U.K. is back near 4.7%. Europe went from negative rates to 2.5% and climbing. Japan's bond market, once a monument to stability, is starting to shake. Japan's government admits its fiscal health is worse than Greece. Debt to GDP over 260%, shrinking population, ballooning pensions, basically a demographic time bomb wrapped in a polite smile. For decades, they've faked balance by buying their own bonds. But once rates rise, that trick stops working. So what does that actually mean? It means pretending to be solvent eventually costs more than being solvent. Footnote. Japan's long-term debt structure depends on suppressed rates, rising yields expose decades of monetary self-deception. 5. The fake fruit economy. Global finance is now mark to model, not mark to market. Translation: banks pretend their portfolios are worth what they wish they were worth. It's like displaying fake fruit on the table and calling it dinner. Insurance companies and pension funds love higher rates, on paper. But when they have to revalue their bond holdings, the losses are massive. They simply don't talk about it because, well, numbers are awkward. Footnote. Artificial accounting standards hide systemic losses, masking insolvency risk in rising rate environments. 6. The Austrian lesson. The Austrian century bond was issued in 2017. It traded at 158 cents on the euro in 2019. By 2025, it's around 61. That's not a typo. That's a financial faceplant. Investors bet that negative rates would last forever. They didn't. When rates went from near 0 to 3%, those long bonds imploded. The moral of the story: never lend to a government for 100 years unless you plan to live that long, and even then, don't. Footnote: ultra-long sovereign bonds amplify rate risk, making small yield increases catastrophic for valuation. 7. The quiet panic. Bond auctions are starting to fail. The U.S. couldn't fully sell a $16 billion 20-year issue. Japan had similar trouble. Normally, higher yields attract buyers. But when both bonds and currencies fall, that's a signal: the exit lights are flashing. The result: rising yields, falling currencies, declining equities, all at once. That's not a correction. That's a prelude. Footnote: simultaneous declines in bonds, currencies, and equities signify systemic liquidity withdrawal. 8. The gold signal. When everything else falls, gold rises quietly. It's up over 25% this year. Bitcoin? Up when markets calm, down when they panic, like a teenager with mood swings. Gold's strength isn't speculation, it's a signal. It's the market whispering, "I don't trust paper anymore." So what does that actually mean? It means people are starting to hedge against the possibility that money itself may not stay money. Footnote: gold historically outperforms during rising rate and inflationary environments as faith in fiat erodes. 9. The wake-up call. Big bank CEOs now admit it. Credit ratings don't measure inflation theft. Moody's downgrades mean little when governments can just print to pay debt. It's not default risk, it's value risk. Central banks used to control markets with speeches. Now, they're just hoping nobody looks behind the curtain. Complacent might be the kindest word for them. Delusional might be closer. Footnote: monetary policy credibility declines when inflation erodes bondholder value faster than yield compensations. 10. The way out. So how do you prepare when the system creaks under its own weight? You start by holding cash short-term and real assets long-term. Cash buys you time. Gold buys you freedom. Inflation and default are two doors to the same room: debt destruction. Governments always choose inflation because it's the quieter scandal. The rest of us just need to make sure we're not sitting too close to the fire when it happens. So what does that actually mean? It means if you don't have a plan before the bond market breaks, you are the plan. Footnote: the historical pattern of debt crises shows inflation as the preferred political tool for avoiding explicit default.